Hello everyone, this is Jason. I hope this video finds you doing well. It is Saturday, March the 9th. We're going to do a week in review video just to kind of look at the market, see what happened this week, what our thought process is maybe going forward. If you're new to the channel, please subscribe and also follow me on Twitter. It's at CryptoBitJunky. What we do on this channel is every week I go live, and on the live broadcast you can enter the chat, tell me which chart you want me to look at in any industry or any market, and I'll pull up the chart and break it down from a technical level and give you my opinion on it. And that's what we do every week, like once a week, Wednesday or Thursday most of the time. And so follow me on Twitter because I announce what day and what time on Twitter. So at CryptoBitJunky, and the handle will be in the description box. So this week, if you've been following the channel, we finally got some type of bearish activity going in the market. We've been talking about being in a resistance area for, it looks like, over, I don't know, 4 or 5 weeks now, and consistently the prices continue to drag up. And finally we had kind of a reaction this week, but I noticed something interesting about it too, and this is why in trading, having a good trading strategy is important, but sound money management and diversification of your trades is important, or just as important as what your strategy really is. And this is a good example of it. Okay, so let's take a look at the broad market. So this is SPY, and we had this this resistance area. The red lines represent monthly resistance. We've had this area identified for, I don't know, I think sometime in January maybe. This ended up on the chart at the beginning. And so we've had this area kind of pegged this whole time that this would be the area that the price could turn around. All right, now one thing that's interesting is at the end of every week and at the end of every month, I go back into my charts and I adjust my support resistance levels on the monthly and weekly charts. Well, I mean, my thought after doing it this morning on the weekly charts is, man, that happened fast. I say 80 to 85% of my charts changed the weekly bias to down just based on last week's movements. And I mean, that means that means we were set to go back down, because that means that most of the time what that means is that the angle of the rise was too steep. So all it took was a small bearish, reversal to trigger polarity change on the weekly chart. And I saw that across 85% of my charts. It changed to down, to bearish. And the interesting thing about that is, let me see if I can find one and pull it up just to give you an example. I'll just grab the first one. Yeah, Netflix turned bearish, but that's not the example I'm looking for. Okay, Johnson & Johnson, for example, right? So Johnson & Johnson, the polarity was up on a weekly chart. Okay, so we had, support down here. All right, but when polarity changed to down on a weekly chart, what that tells you is the angle of the rise was too steep, like this. So all it took was a small bearish break to change the rate of rise, which is an early indication of a polarity change. And then it happened at monthly resistance, as we kind of predicted. So when you zoom out on this, it kind of just, if the market continues to fall down here, and I think there will be support down here, that we've talked about this before, I think there will be some support down here when it gets there. But if you go back and look at this, you kind of forget about this long run up we had since December on Christmas Eve all the way until basically about a week or two ago. That whole run up could be invalidated in the next week or so. The market could be right back down here to this support area, because typically markets fall a lot faster than they rise. I mean, if you look on SPY, let's go to the daily chart so you can really get a better feel for it. So we've had basically 1, 2, 3, 4, maybe 4 or 5 bearish days in a row, but they kind of wiped out. They kind of wiped out all the profits from here to here. So 3 days wiped out 15 days worth of profits. And we have support down here for the overall move, and we don't know how far it's going to go down. I think we're going to hit support, as we go down too, but that's how you get the retracements that take it down. That's why the market never moves in one direction directly. You get this kind of deal here, retracements, and that's how it goes lower. But I think there's going to be some serious support down here when we get there. All right, so But I want to keep this video short. So, I mean, if you've been following the videos, you know what we think. The market is reached in a resistance area. This is a natural occurrence. It should start to go down. But let me identify something real quick. And just to show you why your trading, your risk reward ratios and money management is so important. All right. So this is, which one do I want to show first? Let's go to the Russell real quick. I want to show you something. All right. Well, let me make the chart bigger first. All right. So take a look at this chart. We've got monthly resistance here. We've got weekly support down here. We had the market come down, make a low, V bottom, come up to the resistance area, and it looks as though we're starting to make a turn. All right. So let me show you a commonality. So let's look at the Russell. It's not identical because, you know, the resistance lines on the SPY chart were kind of higher, closer to the 78% retracement, which is this top red line. So the peak that it had was closer up here, but it's kind of a similar scenario. It's come down, made a V bottom, weekly support in the resistance area, and the price turn. But let me point something to you, show you something real quick. All right, so I trade. I don't want to make this video long, so I don't want to get into the reason why I use time to mark. But time to mark trend lines are completely dynamic, and they change as the price changes. And that's your edge in the market. If you ask someone to draw a trend line on this move right here, people are going to say, well, you want to get as many touches as you can, and you might draw the line like that, right? And that's a pretty good line. 1, 2, 3, 4, 5 touches, right? That's a good line. And price just broke that line right there. All right, so now you could say that this rate of rise, this uptrend is over, and now it's going down. But let me show you where time to mark would have helped you out faster. Time to mark, you're only looking at the last 2 lines. All right, so there's a line. And let me get my magnet. You know, there's a line here, and it's dynamic. It's as the price changes, the rate of the rise changes with the line. All right, so let me point you to something real quick. Right here, my mouse is very sensitive. Right here, you had where the price crossed over and closed 1, 2, 3 days on the other side of this line, which in a lot of cases can be a bearish indication. And the fact that this is happening at a resistance area says, hey, this is a good spot to sell. Me personally, I would look to go short here. So if I was to say I'm going to sell the retracement, all right, so let's zoom in a little bit further on the hourly chart because it's kind of hard to see it like this. All right. So on an hourly chart, price made a peak, it broke through that trend line, came down here. So I may be looking to sell in this area right here. And within these blue lines is where I would be looking to enter a sell position, right? So let's say I entered here. My stop loss is back here above the high, all right? Now that trade, obviously, let's go back to the daily chart, which is kind of zoomed out a little bit, but obviously that trade would have worked out. You know, all this downside and my stop would have been behind this swing high, right? So it's a good trade. All right. In a resistance area, trend line break, retracement, enter short, profit. All right, let's go to SPY. Same exact scenario. That's why I always have to toggle the magnet on and off because it wants to snap to the top of the candle. It's probably the only thing that makes it difficult. All right, so same scenario here. Price, the rate of rise is here. You're in a resistance area. Price close on the other side of it, 1, 2, 3 days. You may be looking to go short, okay? Now let's zoom in on the daily chart and see how that thing played out. All right, so here's the high that previously was there before the trend was broken. There's the, okay, sorry, magnet. All right, so there's the high. There's the low. You're looking to go short in here somewhere. And let's say I entered, short here, looking for it to go down. And look what the price did. Now, this is an hourly chart. So right here, there were people there that got short. The market, knowing we're at resistance, knowing the polarity has changed, gapped the market up. So this is from the 9th. Let's see. This is March 1st and then the 4th of March. So over the weekend, market close, the price gapped up, which took out a lot of the stops that were tucked right behind this high, right? And then immediately, within 2 hours, created a new low. See? And this is why no trading strategy in the market is 100% accurate, because there is absolutely nothing you could have done about this. And you could say, hey, use a bigger stop, but that affects your risk reward ratio on where you want to exit. The key is, if you use proper money management and you're winning, let's say you're risking 1% on your trade and you win 2% on your winners and you lose 1% on your losers, you could have taken the IWM trade and the SPY trade basically on the same day. One of them would have been a winner and one of them would have been a loser. Now, if you would have made 2% on the IWM trade, the Russell trade, that's plus 2%. You would have lost 1% on this trade. You're still a net plus 1%. This is why diversifying your trades and why trading, having a good risk reward ratio is important, because the market's going to do stuff like this to you all the time. In both cases, you were completely right about the market direction. Look where the market went after this. You're completely right about the direction, but you're wrong for the timing. And there was nothing you could have done to prevent this. And this is what the market's going to do. You're going to be wrong, not because you're wrong about direction or your analysis is incorrect. It's just really, really difficult to time the market. So this is just an example that it's more than just your trading strategy. You have to have strong money management and a good risk reward ratio in your trades, because the exact same thing trade on two different charts will look exactly the same. You can take both trades and you'll get a different result, even though you're correct about both of them. It's about timing. So using really good timing tools, and this is why it's good to have some type of leading indicator and not use a lot of laggy stuff, because you want your timing to be as good as it can be. So I'm going to make this video a little shorter. So that's where I'm going to stop there. I just wanted to point that out real quick. It looks like we're starting to go down and get the kind of the reaction we've been talking about for quite a while. I'm bearish on, like I said, 85% of my charts. So I think we've got a tremendous amount of downside. Now we're going to fight a war down here when we get there, but I think the market's going to go pretty far from here. Now, again, I don't think it's going to go straight down. We can get a retest back up here and then it drops a little lower. We can consolidate and then continue down. It could be a process, but this is a resistance area. These things typically have, pretty strong reactions in these zones. So if you like the video, hit the thumbs up button. Don't forget to follow me on Twitter so you know when we go live, and I will talk to you guys next week when we see what the market's going to do then. All right, have a good weekend.